Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. And world on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got its time. Yeah, but we all think you're crazy. You don't fight this. No way. But the markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Well, folks, it looks like we're going to have a recession. At least that is what the major Wall Street analysts are telling us now, as yesterday we had a huge move, and after a report from the Wall Street Journal that suggested the Federal Reserve will raise 75 basis points tomorrow instead of 50 basis points, and the Goldman Sachs analyst saying that that will trigger a recession. Or rather, that the soft landing scenario is not going to happen. So we come over here to the charts. Of course, we are well below the 20% bear market territory. Actually, you know what? Here, real quick, let's just modify this line here. Properties. Levels. Okay. 30% visible. Okay. Apply. Okay. So they're looking at oh man. Some of the analysts are saying like 3,100. There, let's come in here and add another one. 40%. 40% decline. Apply. Okay, so we might get like a 35% decline in this bear market is kind of what it's looking like. So come over here and look at the moves. Like, look at this. Now the treasuries are higher, but this is woo. That's just a move. And that little bit at the end, that was the piece of news. So absolutely nuts. Here's the S&P 500. I'm really thinking, like, the problem is, where do you catch the spot, right? Because I really feel like I should be short this thing. You know? Here's oil. Oil's still kind of a little sideways. Gold and silver getting hammered yesterday. So inflation pushes them up, but then higher interest rates destroys them. Very curious. Silver. Copper, not looking so hot. Copper's the one that we really got to watch. That's like, copper's like, hey, okay, we're going to have a recession. All right, let's do it. Copper. Longer term, copper's probably a really good bet to make, but not until we get the economy going again. And then here, Bitcoin. Bitcoin dipping momentarily below 2,100 yesterday, and I do not believe that the pain is over. Oh, we're getting PPI news. I'm sorry, I'm so slow. US PPI month over month, spot 8 versus an expected spot 8. Core PPI, spot 5 versus an expected spot 6. So that is a good number. I'm not sure what we're going to make of all of that. By the way, here's the dollar. The dollar dropping on this news. Welcome back to the bear market. You know what? I was born in a bear market. And to me, it's not so bad. Now, I bumped my camera yesterday, and it's kind of bothering me here. There, I think that's more correct. 30-year fixed rate mortgage surges to 6.1. Bitcoin poised to rally on account of new Michael Saylor profile. Wait. What? Oh boy, Nalvani transferred from penal colony. His whereabouts unknown. His spokesperson says all the time, we don't know where Alexei is. He is face to face with the system that has already tried to kill him, so we need to find him as soon as possible. And Taleb continuing his feud with Snowden, saying why is Snowden silent about this? Because his job now is only reveal things that weaken the US and benefit Putin. I'm with Taleb on this. I don't really like Snowden. He did that was, it was information that we needed to know, but he went about it the wrong way. I guess I don't want to focus on that too much. I'm always interested in what Nassim says. Really like this guy. He's so interesting to me. I mean, I don't agree with all of his political opinions and everything, but like which side he falls on things and stuff is very interesting to me. Well, this is a pretty decent move up here. I don't know, though, that if the PPIs really... I don't know. So are we really not going to address ZN liquidity? Well, with PPI, I don't think that this is unexpected, right? Give them 30 minutes. It's usually these market makers don't turn their robots back on until like 5 minutes afterwards. So I'm just gonna let it be for the moment. Hey, look, the micros aren't so bad. At least you're getting a spread. Look at the 5-year. 20 tick spread. What? Ugh. Like this thing, this right here, the 5-year being so bad is really dumb, because the 5 is the place that's moving. Nah, I'm you don't think it's because of PPI? Why not? You give them 5 to 30 minutes and you'll be back over thousands. Like we were yesterday. Maybe even well, I don't think that you get it this week, but maybe next week we get back into the 2000s. I'm sure that somebody got screwed yesterday, though, man. Anybody that was market making on the buy side yesterday got burned hard, right? Because we were coming in, we were talking about like, oh well, I would rather be going long yields here, right? And the beginning of the session, we didn't really like it yesterday. They did eventually get moving, but that wasn't until long after the S&P 500 had moved. And really, the bulk of the move that happened yesterday was long after we stopped trading. And then the yields spiked 28 basis points. I should have mentioned that in my opening thing. I guess I was kind of like, I was done with it. You know what? One of the problems that I have is that like, to me, it's like I talked about it. So like, I don't need to talk about it again, but I don't realize that not everybody that comes in is here talking about it, right? When we go to a daily chart in the 10-year, right? And we look at the daily yield, that was a 28 basis point move yesterday. Dwarfs, it's almost double. It's almost double. It's not quite double. What any other single day throughout the rest of all of this. Now I will note, there was this one day, the beginning of March. That was the one that was probably the one that comes closest. And note the next day after that, quite a bit of mean reversion. Then the next one after that was like at the beginning of the year when things really started taking off, and that one continued. So a candle like this kind of suggests more volatility. Right. So it would not surprise me to see lower liquidity today because of the Wall Street Journal story yesterday and the fact that we've got a Federal Reserve meeting tomorrow that kind of adds a little bit of uncertainty. I mean, the market is saying that it's going to be a 75 basis point hike, but the way that it was revealed and everything, I think kind of gives us a little bit of uncertainty. But the PPI news is really significant too. I wouldn't discount that, right? So I think that we should give it 30 minutes before we make too much of a conclusion on how bad the liquidity is. If the liquidity is still below 1,000 after 30 minutes, then we've definitely got a problem, right? Well, actually, I take that back. I'm not going to say like we have a problem. Like it sucks. It sucks for us. But, you know, if we have that low liquidity and that continues through the month, then that's going to be a problem for the financial system, right? It was scary. That move yesterday was scary. It's kind of funny that I'm already past it. Like I didn't trade it, obviously, but like, come on, man. We might never see a move like that again. And I was sat on the sidelines the whole time. It was okay. It was a little bit out of nowhere, to be honest with you. Kind of crazy. It was kind of a crazy move. Since when does the U.S. Treasury take 30 minutes to recover from the news release? Always. Okay, so always. Dude, so there are kind of two levels, right? After a major news event, and when I'm talking like a tier 1 news event, there's usually a change in liquidity 5 minutes afterwards and 30 minutes afterwards. Go back and look. It's usually not something that I focus too much on, because that decrease in liquidity is usually, kind of helps you if you want to scalp, I guess. I don't know if I would say it kind of helps you. It creates more volatility, right? Yeah, if we got back to 1.5K per price, that would be relatively low liquidity, but that would be what it has been in the past 6 months, right? So if we can get to 1.5 per price by the top of the hour. If we're not over 1,000 at the top of the hour, then I'm going to be starting to look at this and going, maybe this presents some opportunities to see some action both ways. Although, do I really want to take it? Will you stream FOMC? Of course. Of course. Do I ever not? Have I ever, in 5 years of streaming, ever missed an FOMC? Pretty sure no. Oh man, oil is taking off here this morning. I did not notice that since the top of the last 40 minutes, oil has been just rearing higher. So I had a thought this morning. I need to come and look at a chart on oil. Okay, so the question is, answer me this one. Was the last time you saw 500 per level on ZN 10 minutes after 8:30? 3 weeks ago? Well, it was definitely like that after the jobs report last week, right? But then before that, it was probably last CPI. I got smoked last time. I'm not trading again. Well, don't. You know what? I didn't take any trades yesterday. I feel like I should have, because I was on the right side of the market, but this is a volatile market. And even though I might catch a lucky trade like that from time to time, probably got to be more careful. Yeah, the FOMC is tomorrow. I think that the bigger risk that you guys face here right now, if we're going into a recession, is getting caught up in the chop and wasting all of your funds before the real opportunities come along, right? Okay, so I want to look at like a stock that is like oil infrastructure. Yeah, does not look good. One day. Oh, you know what? We got to take off. Yeah, okay. So, oh, you know what? I shouldn't have done that. Add symbol, else, new, same percentage scale. We'll just do lines. Okay. So if we come back to here, it has been outperforming the S&P 500. It has been, but not, probably not outperforming United States Oil Fund, huh? Yeah. United States Oil Fund is way up. Or what do you mean by our 401k at risk here? If you sold, obviously you can't do that. Like the 401k is designed so that you really can't mess with it, right? But if you were to sell today, you took advantage of any kind of pop that you might get in the S&P, and who knows, it might be that after the options expiration we might see a little bit of a bid as well. Okay. By the way, I don't like this. Hold on. Should I be doing something with this? I feel like maybe I should. Okay, I think I kind of got my spots. All right. If you were to sell the S&P 500 today, and wait 3 months, I think you'd probably make money. Right. But it's possible that today is the day where like we all get overly bearish and the market turns out to be just fine. And clearly the market is saying that PPI print makes a big difference, right? Like what I'm seeing at the moment is that we were saying there's a lot of reason to believe that we have already hit peak inflation and all that, right? And then we had the CPI numbers come out and they were really, really bad. But when I look at the CPI number, what I see is that those inflationary pressures that we were talking about are actually subsiding, and they're being replaced by energy driven inflation, right? That's what it looks like to me. And so to see this PPI come out and be mostly in line, I think kind of reinforces that that conclusion as well. So that's both good and bad, right? Because the energy inflation that we're seeing, in my opinion, is almost exclusively being caused by Joe Biden's policies. And that's something that's not going to change for another 2 years. So are we going to see a time period where for the next 2 years we get low growth and high inflation because of bad energy policy? That's something we might be staring the face in. You think that energy is in a huge bubble? I don't. So like the argument I was trying to make, I don't think that the chart really shows it here. But like, here's the thing. Liberals are really upset that the oil companies are making a lot of money, right? When they were asking Joe Biden about the problems and everything, he was saying that, the oil companies are making more money than God, is what they said. Listen, everybody makes more money than God. God doesn't make any money. Okay. But I digress. Okay, so if that's a problem, you think that oil companies should drill more, okay? Why don't you put your money into that? You think that we should be drilling more? You think that we have every reason to drill more? Why don't you take your money and you go and you start buying leases and so forth, and you develop land for an oil well. Huh? If it's really like such a no-brainer, then go do it. Right? Well, you're not going to do it. Why would they? I mean, if it was speaking to the far left right now, they wouldn't do that, right? Say, I'm not going to invest in something that's destroying the environment. No, yeah. See, it doesn't make any sense to invest in oil because, like, you're going to reduce your profits in the short term, and in the long term, you're not going to make any money because the administration is just going to turn around and try and screw you over because their policy. Make no mistake about it, the Democrat policy is that oil should be more expensive so that we use other sources of energy. That's their policy. And I tell you what, renewables ain't enough. There's problems with renewables. There's a lot of countries that have enough renewables, really, like much renewables as they would need for their country, but they still have problems because renewables are not reliable. Right? They don't provide reliable energy. And there's no way to store the energy efficiently. So renewables can't do it. The only thing that you can do is you can keep the current energy prices low and invest in nuclear. And the left is not doing either of those two things. Now, I don't mean this to be like a political thing, like if you're a liberal, then you should hate this stream and go away and I'm chasing you off. But I'm merely trying to point out the potential economic hurdle that we face now, that the economic situation that we're in right now could persist for many years because of current policies. Policy is not capable to dictate prices. Well, of course they're not. Policy is going to have a limited effect on prices in the short term, sure. But if you want oil companies to drill more, they're not just going to do it. Look, are you going to go and drill a new well today? If you had the money, would you go and drill a new well today? I don't think you would. Like, here's the thing. You know that these oil companies, like, their profit margin is only like 6%. It's actually, the profit margin is really low, comparatively speaking. 6% isn't very good, right? Like investors demand more than 6% these days, right? So for starters, you're talking about something that doesn't have a very good profit margin to begin with, and then you're talking about something where the whole world is trying to make a huge push to put you out of business. Who's going to drill in that situation? New well takes a 10-year. Is that really true? It takes that long? Kind of depends. Like, the thing is that there was all of this investment in Shell that had kind of been shuttered, but like was ready to go. And I read this story yesterday. These guys came in and they thought, okay, like Shell will be this is the time where Shell will make sense and we can do a lot of Shell development because the price of oil is high enough now to make it profitable. And nobody was interested in doing it. Nobody was interested in doing it because they thought that, 2 years from now, they'll just get screwed. Warren is, yeah, but that's the kind of the thing. I don't think that the chart makes the point, but I may still have a point. If you were going to invest in oil, who would you invest in right now? Right? Warren Buffett put money in Exxon. I think that's a good call. I bought some Berkshire Hathaway because I like the moves that he's making. I think that Berkshire Hathaway should do really good when we come out of a recession. But you notice he's doing Chevron and not Kinder Morgan, right? They're buying in the people that are already pumping the gas and not the people that would be involved in like the infrastructure and the new well development and all that stuff, right? Oh yeah, that's the Chevron CEO interview. Yeah, that's good. That's a good example. because he kind of talks in and talks about all of the we say the roadblocks to new oil and gas development. But we're kind of getting a little bit off track here, right? The point is this: the current economic environment is not very good for oil and gas exploration, despite the high oil price, and that is unlikely to change until Joe Biden is out of office, even if the Republicans completely sweep things in the midterms, which means that the high inflation could persist for several years. If what we're seeing right now, because again, the whole way that this whole started is when I look at the numbers, I'm usually saying, the thing that I really care about is the core CPI, right? Because generally speaking, we know what like oil prices have gone up and so on and so forth. So like we might know that the headline CPI might be really high, right? We want that core one to kind of see like what's going on underneath, right? But really, at this point, I think, and what we saw on Friday, is that headline CPI matters more and more, because now it's like, yeah, we know that we're getting inflation from energy, but how much inflation we're getting from energy is now like the critical decision data point that matters now, is how much is it actually contributing now, right? Because we know that the biggest driver of inflation at this point is energy. And if that's the case, what's going to cause that energy inflation to decline? A new president. Otherwise, well, you know what? Joe Biden is going to go and visit the Saudis. I think this week, right? I think they said the 16th, 15th, and 16th or something. So like tomorrow, is that tomorrow, or did I get that wrong and it's in July? Hold on, let me come back and let me find that. Ooh, that reminds me, there's something else we gotta look at. Belag. Oh, okay, it is July. Biden will visit Saudi Arabia on July 15th and 16th. So a month from now, he'll visit the Saudis. Maybe that will help. Blue or red is not going to, I think it would make a big difference to the oil. If Republicans were 100% in charge, they would start drilling so much effing oil. It would like if Republicans, let me tell you something, man. If Republicans had a filibuster-proof majority in the Senate, they would be drilling more. they would be, let's do Anwar, let's do the oil pipeline, let's do more sea exploration, let's do shale, let's get rid of any kind of regulation that makes it more expensive, regardless of whether or not it's actually a good regulation. like they would 100%, oil would be cheaper. And it would also be, I think that the place that the Republican Party has come to at the current time, of course this could change, but I think where the Republican Party is at the current time is, let's bow in front of the Saudis and get them to pump as much oil as possible too. Yeah. It's most likely bringing energy prices. Well, okay, so if we have a recession, that will bring the price of oil down, right? And you can see here at times, although it's not happening today, when there are concerns about the economy, oil goes down. But how long does it take? Well, somebody just said that it takes 10 years. But you got to realize that there's lots of investments that were kind of like already in progress and were kind of shelved, right? Like, it's not hard to come over here. Let's see here. U.S. oil production. chart. I guess I need to put chart on the end of that. This thing right here. Nope, that one's not new enough. Let's see if I get, will the EIA do give me a dynamic one? Oh, here, maybe macro trends. We'll do it. There you go. Okay. Like, look, when Obama came in, that made a difference, right? Obama was, didn't hurt things. And I think that there was kind of stuff had already kind of started. So for most of Obama, it was pretty good. This was the taper tantrum right here. And then Donald Trump was in, and guess what? Donald Trump was really favorable too, of course, right? And then we get into 2020, right? So here's the thing: is like when you come back and we look at this, like, okay, so here was a drop in 2012, for instance, came back real quickly, right? Now it's like it's not coming back online. It actually, what I'm suggesting is this. We may see oil production do this for 2 years. Just go sideways. Because they're not pumping more oil. They're not investing right now. Yeah, we're about 30 minutes afterwards, and it's still pretty low, isn't it? So I think that now at this point we have to say that liquidity is probably weak because we had such a high range day yesterday, and the market makers are taking less risk as a result of that. So then we go back to what I was saying earlier. I don't know if that's like has to be a huge problem for anybody other than you and I, right? If this stays like this for too long, it's a problem, but I don't know. I think where you would really start to get a problem is another shoe drops today and they really go like straight to 3.5%, right? That then we might have a liquidity problem in the treasury market. Otherwise, I don't know if it's a huge deal, to be honest with you, Lucas. Other than a factor that we have to consider in our trading. We have high volatility right now, so you can't. Okay, so that's not what I wanted to see. Well, I mean, it is what I wanted to see, but like, was there a piece of news that made that one happen? Yeah, they're not even trading the thousands, are they? It's not. But how much liquidity is out there does matter, right? Because what it basically is saying is that there is a market maker out there, or maybe multiple market makers that have either decided to leave the market or just not put much up. Well, Hydro's talking about. You're talking. I'm kind of. I think you've kind of lost me. The question was, what do we do about energy driven inflation? Right? Because here's the thing. So some of you guys have said it takes a long time to explore for oil and all of these other things, right? But all of those things that you're saying reinforce the primary theory and really just make it worse. Is what you're saying is energy driven inflation is likely to be a thing for several years, right? And what you're saying is suggesting that not even Joe Biden getting out of office will do it. That it will take even longer than that to fix the problem. I'm not entirely convinced about that. Like I think that hey, we might get to a new high in oil production before the end of Joe Biden's term. I hope so. I hope so. And if we don't, then we will certainly do it shortly after Joe Biden's term. Making moves more aleatory. I'm not sure what you mean by that, but generally speaking, there's going to be more volatility, right? I mean, look, you had after a move like yesterday, there's going to be a lot of volatility in the treasury market. Making moves more random. Well, okay, yeah, that's okay. That's a little bit more insightful and very true, right? I mean that move that we just got there. Oh my gosh, oil is just going like oil literally just jumped like $1. Like I turn over, I'm looking at it, and it was like 122.6, and then oh no wait, I take that back. That was a minute ago. Okay, so it moved from 123 to 123.20. Oil is just running today. Don't you think that this inflation is here to stay for at least the next 3 years? Yeah, that's what it sounds like to me. That's what I'm saying. So like here's the thing. Analysts are saying we're going to go into a recession, that the higher interest rates are going to create a recession, right? So they can come in and they can hammer the how do I put this? The Federal Reserve is going to come in and spike the interest rates up to slow down the employment market so that we don't get we don't get an unanchoring of inflation expectations. Okay, so if the inflationary pressures are still there, that means that the Federal Reserve is still going to have to keep interest rates high, right? That means that, you know, there might be a bottom somewhere in here, but that we're not getting to like new all-time highs for a long time, right? That the recession that we're going into, it might not be a super deep recession, but it may be a very long duration recession. When a recession driven by high energy prices, right? Like I don't see how you avoid it unless we have like an immediate change in policy. And sure, the Saudis will help, but I'm not even sure that the Saudis can fix it at this point. Because it sounds to me like the Saudis are having trouble pumping more oil themselves. If they keep on keeping rates high, then stock valuation is going to stay low. Yeah. Yellen said, "Well, I don't. I've basically moved camps in the past 24 hours. Okay, when my boys over at 200 West say that this is probably going to drive us into a recession, I take note. When we get to that point, like they're wrong on the edges all the time. Don't get me wrong, but okay, but they're wrong. Don't get me wrong, but." When they're basically being forced at this point to say, well, we're probably like pretty likely that we're going to have a recession, I think at this point, or it's a greater than 50% chance that we're going to have a recession, unless the Federal Reserve pulls a surprise and actually ends up doing a 50 basis point hike tomorrow. There is hope, I guess. So the myth of Paul Volcker and the powerful Fed. I think that there's a lot of analysis out there. I mean, without reading that, I can kind of guess where this is going to go. And this is going to come back to the conspiracy theory that the Federal Reserve doesn't really have a whole lot of control over things in the end. I feel that what we've seen in the past 6 months really disproves that, right? Because it's just that the Federal Reserve doesn't want to come out and straight up say that the way that we prevent inflation from getting out of control is we create a recession and put people out of work. I mean, but that's essentially what they do, right? So you guess that Powell. Okay, let's do a poll. Let's do a poll. Let's see how you guys, where you guys are at. Do you think it'll be 50 or 75? Sure they do. They have a tool for this. They have two tools for this. One, they can run off the balance sheet, and two, they can raise interest rates, right? What do these two tools do? These two tools put less money in the economy, which means less capital available for development, which means a weaker labor market. Which means lower wages. Right? Like the whole thing here that you got to realize, that the point I'm trying to make is, yes, the Federal Reserve can, I don't want to say put a stop, that the Federal Reserve, their job is to stop inflation, and they will stop inflation in its tracks. It's just that it may require putting the economy into a recession. And if the inflation continues through, keeping us there. Right? Essentially, if that's the place that we're going to go, then we're going to continue to be in, if not a recession, a low growth environment until we fix the energy problem. The ECB is late because they will belly up Italy and Greece if they raise rates higher. Well, that is a different problem that I don't understand. But it sounded to me in my news squawk that crazy stuff was happening over there in Europe, and that there was a divergence between Italy and Greece and the other countries, huh? Okay, so I should have bought at 34. Why am I such a pansy, guys? I don't know. Because I'd rather yap, I guess. 3.35 doesn't look terrible to me. They can't comply with price stability? Sure they can. Oh, listen, it's all relative, right? I like really what you're hinting at is this. There are a lot of people, your everyday person, that is not so happy about that 2% that you know, they're putting money away in the bank loses you 2% per year. Right? That's what that really comes down to, right? Federal Reserve policy is that the currency We have inflation at 2% per year, and a lot of people would prefer it to be zero or even negative. They would like their saving their money to be worth more. Okay, well, that's intentional. They don't. I've never heard any statement from the Federal Reserve per se exactly to what I'm going to say, but they've kind of said it more or less that it's good to have a little bit of inflation to encourage people to invest. It's intentional. 2% 2% per year is pretty good. Actually, I would even go as far as to say that, we've had inflation, it's 10%. 10% is actually still pretty darn good. 10% is a lot less than what you would be getting if, for instance, we were on a gold standard or, some commodity based currency. Right. But when you're saying they can't maintain price stability, it's like, well, there's going to be fluctuation, right? What is the acceptable band? Right? And I think that the Federal Reserve's goal is to be like at 2% inflation, give or take maybe 2%, right? But that on average it's supposed to stay at 2%. Well, maybe they can do that. But I think it's a little silly to say that they just can't comply with that mandate at all. I think that the thing that makes this situation disappointing with the Federal Reserve is that it kind of looks like if they had started raising interest rates earlier, that this whole kerfuffle could have been avoided. Let the Fed fix the problem by setting a 10%. Well, no. Like I'm saying, 10% is too high, but 10% is still a lot better than the alternatives. Well, sure. If you raised interest rates to 17, 18%, then you probably would solve the inflation problem, right? But you would just decimate the economy. Well, I don't know. Shoot. Missed it. I think what happened there was like I saw the opportunity, I clicked it. It was probably long gone. Like that was a situation where the 100 milliseconds or so difference was mattered. No, we don't want to decimate the economy. We would prefer to deal with inflation and not have to destroy the economy to do it. Right? No, I was looking to go long the interest rate. Like I was looking to catch the edge. If I had caught the edge, I wouldn't be too bummed about it. But I don't know. The way that the Treasury is kind of acting after that all happened is not particularly encouraging. Because it's kind of looking to me like what's going to happen here is I'm either going to be forced into buying 3.36 if I really want to buy the interest rate, or they're going to have another push, maybe all the way back to, let's say, 115.20. See, like, very volatile. Even though I think that there could be some really good opportunity on the short side here. Sorry, long it rates, short treasuries. The volatility makes me nervous. I feel like such a pansy saying that, but I really think that at the current moment, passing up on all of the opportunity, like this historic volatility, may actually end up being the better call in the long run, because there are going to be other opportunities probably all the rest of this year, right? $116. Anything's possible, but at the moment, it really looks to me like they're going to be pushing back down. That they're gonna push down, and they're gonna start testing. Well, so the first major target to the downside that you're gonna have in the 10-year is 115.08 half, before, which was kind of like the overnight balanced area, right? So there's plenty of room within the volatility of the day for them to move lower, right? Could there be a big move the other way? Sure. Renew your license before August or wait until after? You talking about like your live trade license? Yeah, I gotcha. Good. Phew. Oh, you're using CTS? That's why you were talking about it the other day. By the way, when they broke through there at 14, that was quite the stop run, wasn't it? No, 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 no. So with Jigsaw, there's a lifetime software license, but in order to actually enter orders on the DOM, you have to pay basically $50 a month. It's the current trades column is the only thing you care about. I really think that people discount the power that you get with being able to with the way that you can move the orders around on the DOM in Jigsaw, right? That's the thing that is like actually valuable, is because you can come in and you can do Jigsaw, right? You're looking at the current trades column, and then have your order entry thing over here on your other platform, right? But being able to click right on where you're looking at is like the killer feature. is that the place that you click is the same place as the place that gives you all the current market information, and nothing else does that except for a DOM with a current trades column that you can trade on. So I don't know. Well, at the moment, the treasuries are kind of backing up a little bit. Mm, isn't that a feature any pro dom offers? No, not any. Many, many, but not any. For instance, the NinjaTrader DOM is just absolutely terrible in that respect, right? Yeah. I've never tried this. I have tried this Sierra Charts DOM, but I don't really remember. Don't really remember it, but it seems to me that the Sierra Charts one is fine. The Trading Technologies one is fine. The Bookmap one could be better, but is fine. Most of the other ones that I'm familiar with don't quite hit the mark for me. One of the things that is I think unique about Jigsaw that I think is really particularly important is that I can if I if I click here it's a bid, if I click here it's a stop, right? And in many other platforms, if I want to do a stop, I have to push a different button, or there's weird funky things you have to do to differentiate between them. Whereas Jigsaw, it dynamically decides whether it's a stop, market, or limit order based on where you click, right? John Parlberg, that has nothing to do with NinjaTrader. That's just your data feed. So CQG/Continuum, it generally only gives you 10 levels outside of ES and CL. Whereas if you use Rhythmic, they give you every level. I'm just saying, like here's so if the argument is the live trade license on Jigsaw is too expensive, my counter would be you pay for it somewhere, right? Trading Technologies, you're paying $50 a month. Sierra Charts, you're paying $50 a month. Or maybe isn't Sierra Charts $30 a month? I forget. But like to get all of those features, you are paying a monthly fee in these other ones anyways. So somebody's trying to come in and spam the server and it is just getting deleted hardcore. The worst DOM is NinjaTrader? Maybe. I don't know. It's pretty bad. I have to say it's pretty bad. Especially if you got the dynamic one. You can do Sierra around 30. Wow, okay. So that was a quick move there in the 10-year. Okay, I wish there was, John, but there is not a demo account for Jigsaw. So with Jigsaw, basically the way that one works is you buy the full version, and if you don't like it, then you get a full refund, and they will full refund you. Now you can get demo data. For demo data, I would just go directly to Rhythmic, or you could pick which broker you want to use. You could use AMP, and they'll give you a demo of Rhythmic. It's $50 a month if you pay commissions per trade, I believe. If you want free commissions, Trading Technologies DOM, it costs more. I don't know about that, but my recollection is that with Trading Technologies, there's like one that's like $30 to $50 a month, and there's an advanced one that's more like $100 a month. And the $100 a month is the one that includes like auto spreader and that sort of thing. But it's probably changed since I last looked at it, so you'd have to go and look at that on your own. Does Jigsaw have its own broker? No. Like that's the thing that I like about Jigsaw is that Jigsaw has a wide compatibility, so you can go and use it with just about any broker that you want. I'm using it through NinjaTrader brokerage by bumping the data through NinjaTrader to Jigsaw. But you could go directly to AMP for the cheap one, or you could pick any broker that you wanted. You could even do it through trading technology. You can. There are people out there that have trading technology data and charts and everything, and are executing on the Jigsaw DOM. Because I don't think that the trading technology DOM is quite as good. The thing that Jigsaw kind of introduced to the industry wasn't the DOM. What they introduced to the industry was all of these tiny little enhancements that just kind of make it a little bit easier to read what's going on. I'm not using Kinetic. I could because I'm a vendor. I believe that there's a what do you say? Because I'm a vendor, there's an option where I can get free Kinetic data, but I haven't done that. Yeah. No problem. Another thing on Jigsaw is look in the video description because I have a coupon. Gets you, if you've never bought a Jigsaw product before, it'll give you $100 off if you use the link. So, and then the channel gets a little commission for that too. Speaking of which, I gotta look at something. So, well, I think I want to keep focused, but remember the other day we were talking about News Squawk, and I was like, oh, the News Squawk guys were talking to me, but then they didn't respond back. But he got back to me last night. Let's see here, and I haven't read it yet, but I'll read it. Well, I kind of skimmed it, but okay. Thank you for your email. I'm very sorry for not getting back to you sooner. We are currently offering new subscribers a 50% discount on annual subscriptions if they subscribe by June. However, we can extend this offer until July for your clients. Wow. So are any of you guys interested in a News Squawk subscription? I really like Financial Juice, especially they have like their lifetime subscription. But let's see here. That means that our Forex, fixed income, and multi-asset channels cost $900, $1,500, and $1,800 respectively. Okay, so for what we would use, fixed income, $1,500 in one lump sum for a year is a damn good deal, don't you think? We do offer an affiliate scheme, which would provide clients with 10% discount. And me with a 10% commission. We are currently offering 50% discount. Your clients would not gain an additional 10%. Gotcha. And what have they changed? We are monitoring over double the sources, and we've upgraded our software/hardware, so it's the fastest our Squawk has been. Big changes will come in Q4 when our new platform will be launched. We will have a new crypto feed, beefed up equities offering, and multiple new text feeds. Well, that is all quite impressive. Okay, I'm not super happy about the price that I ended up getting on this trade, but it does appear to be doing what I wanted to, so. Let's see here, Jigsaw LTQ solution. Oh, are you talking about the last traded quantity thing? LTQ from TT is much more fluid. Yeah, I honestly, you guys have talked about it many times. Like we've gone into it many times before and everything. I just don't get the point of the LTQ thing. I've never, just from watching it, I've never seen any pattern in LTQ that tells me anything. Or at least that tells me anything that I don't see from the current trades column. So are you happy with 10 levels on the book? You know, having 10 levels on the book in the 10-year treasury is not so bad. The thing that bothers me about CQG data is that I have to go through the bridge. So with Rhythmic, you get Rhythmic Trader Pro, and then all of your other applications can connect to Rhythmic Trader Pro. So the data is way more flexible in that respect. So that's the main reason why I preferred Rhythmic data. MBO is all just a gimmick. I wouldn't say that. There was a study a guy did that where they were feeding market depth information into a neural network, and they found that by feeding in MBO data versus regular data, that the neural network performed better. So there is some evidence. I wouldn't say that's very conclusive, but there is some evidence to suggest that there is enough additional informational content within MBO that it can improve your performance. If only, slightly. It doesn't get more alloy, but what do you do with it? All it tells you is how big the last order that traded was. Why is that relevant compared to seeing the current trades? How many orders it took to clear the price? It frequently collapses the Rhythmic stream. Yesterday on the open, they had a ping of 3. What? Really? Well, but I've had problems with CQG data too, though, to be honest with you. Like if you really want solid data, you need to be paying up for the trading technologies data or the kinetic data. Or what's the other one? That's basically the same as kinetic. I don't remember anymore. You don't know the difference between last traded or so no. Let me say it again. Why does the last traded quantity matter compared to how many orders it took to clear price? Right? IQ feed, yes, that's right. That's funny. Two of you guys know exactly what yeah, IQ feed. IQ feed is good. IQ feed is good. I don't know. I have to say, when the market gets really crazy, it seems like all the retail feeds will get stressed a little bit. So I think what they do is they kind of have like a load balancing schema set up, and when all of a sudden they have to start sending out more data packets than they have the capacity to push, then they start aggregating things, and then you get kind of some of the things that people complain about. You want to go back to TT? Well, I'm really interested in TT right now because I really want broker tech data. If you're not a scalper, you won't understand it. No, but you're going to have to give me a specific example of how it's used. Right? Because okay, let me try and approach it from this direction instead. Explain to me, or better yet, prove to me that the last traded quantity is an actual edge and not just a random number. Because what I see is it's usually 1, and if it's not 1, it's a random number. That's what I think of LTQ. How do you know that it's providing an edge? And if that is an edge, what is it? How are you actually using it? Or here's another take on it. Why should I use LTQ instead of reconstructed tape? Right? LTQ changes so fast. Reconstructed tape, you actually kind of can see what orders were in there. Well, I tell you what, these treasury markets are getting awfully choppy here, aren't they? It looks to me like the spread has not been necessarily in my favor. So they did push lower. I would say they made some considerably big takes on the downside in the 10-year, but are now bouncing and threatening to go higher. And or maybe come back and do a higher low or something like that. How to scout this? So you're not convincing me. I still think it's just a random number. How many limit orders there are at each price is something that matters. How many actually end up trading when it clears the price, that's something that matters. The composition of all of the orders inside of it, unless there's a really big order in there, is irrelevant. It is essentially, for all intents and purposes, random. Hmm. Yeah, see, it's still kind of doing this thing where it's like, okay, we're pushing up, and then they don't push up, they tick down, and then immediately it ticks down another on only 73 contracts, right? So like you got a very illiquid market with all sorts of fun shenanigans going on from market makers. Oh, and by the way, despite that move over here, the 30-year didn't move at all. In fact, the 30-year is maybe up a tick. What they think the tape is? Well, you're getting into an issue where there's a lot of different words for the same things, and people use the same words for marketing purposes. You think it's random? Well, but again, yeah. Okay. Well, if you think it means something, then go ahead. But I mean, I understand what it's showing you, right? Let's just review here. LTQ is last traded quantity. So it's basically the number that it's showing to you is what the last order that came through was. So for instance, right here, I can look at my tape on the 10-year, right? And when we finish, it'll show 3 because there's 3 lots. 1, right? Now it'll show 1 because that was what the last order that was on there. And I'm saying the last order that came through, it's usually 1, generally irrelevant. There was one, that one would have showed 118 for a moment because they cleared a price. Maybe that's a little more significant if somebody tried to sweep a price. It's one of the oldest, most well-known strat. I don't know. I've never seen. I know there are people that like the LTQ thing, but I really think that the reason they were using LTQ is because they couldn't see the orders coming through on the current trades column. Like in my opinion, the reason LTQ became popular in the first place through the trading technologies, Dom, is because they didn't have the current trades column. In my opinion, but I don't know. It's kind of the same thing that you always get. It's like, well, I think it has an edge. I'm not going to prove it to you. Okay, well, then don't bring it up. I guess you brought it up because you think it's an important feature in your software. So fair enough. Fair enough. I don't care about it. It's a random number. mean, if you want to convince me otherwise, you're gonna have to show some empirical evidence showing that number matters. But since you're not going to share that, I am left with just telling people that it's probably just a random number. Well, see, you got that. It's not going my way. Oh, I meant tape reading in general because he said it isn't popular. Well, yeah, but like I said, a lot of people do tape reading. You know, like I was going on that rant the other day about price action, right? Somebody comes in here, I'm going to teach you about price action. And what they come in and they say is price action is a bunch of doji patterns, candlestick patterns, rather. A bunch of candlesticks. So price action is actually technical analysis, is what you're telling me. The oldest style of technical analysis, really, because that's, you know, the first technical analysis trader, that Chinese guy that invented candlestick charts, basically, right? What's that word you like, Seth? Are you saying empirical? It's with an E. Empirical. Empirical. Let's do a very, very precise definition. Empirical, based on, concerned with, or verifiable by observation rather than theory or pure logic. Yeah, well, sorry, it was a Japanese guy, yeah. Every time you say empirical, you're going to do a push-up. Okay, you might get a good workout. Yeah. The tape is not a general. Well, yeah, but people will call different things the tape, right? So you got to understand. You know what the tape really actually is? Like the tape as it was originally is this summary tape thing here. Okay, the summary tape. Yes. Oh, sorry, we got to do it over here. Platform. No, let's do it on ZN. Okay. Summary tape. It'll come in and it'll tell you, here's the price, here's how many contracts traded, and it tells you that every time that the price changes, right? That is what back in the 1920s, and you had like a little machine that would give you stock quotes. That's how it was working. That is the tape. Okay. Everything else that you've heard since then is people co-opting that term for marketing purposes because it has a positive connotation, right? Back then, the tape was like you were a real professional, right? If you had one of those in your office, you were a real professional, right? So then people have always kind of morphed it around. So some people will say that when you're watching the DOM, you're looking at the tape. Well, it's the same data. All of the same data is there on the DOM in some form. It's just, can you tell when you're looking at the current trades column and you're watching this, how much it actually was? It's kind of hard. Okay. So then you have LTQ. LTQ changes so fast. I'm just say LTQ changes so fast. But again, it's only showing you that last order. That thing that you have up there is not showing the bit. Actually, yes, it does. Let me pull it back up here. I might not have had it set up with the settings that I had. So like if we change it to 10-year, right? Pretty sure that I can have it show the bid ask spread. Okay. I think I just have to add it in the settings. Show depth. Now, unfortunately, you have to see an order actually go through. So, well, I'm kind of wondering, like the treasuries, they made a pretty good push there down at the bottom, but they didn't really extend. I'm kind of wondering if that failure to break through the bottom basically puts us at maybe you shouldn't take any more trades today. What are your thoughts on the Wyckoff method? So I think that there are a lot of flaws in how people try to apply it to trading. And okay, like this whole thing, this whole thing about there's this pattern and it looks like this. And then there's a little further move down, and then that's when it actually takes off, and you're looking for that. That's technical analysis. Just ignore it. Markets are statistically efficient. Yeah, choppy day. Yeah, I mean, I'm a little frustrated because I feel like that it could flip down again and go to a new low at any moment, but it's not really cooperating. Probably should leave it alone. My great grandfather used Wyckoff. Did I already close my stupid summary tape? Why did I do that? I changed it to ZN so that you can see that there quickly. Okay. Show depth. There we go. Okay. Now your summary tape tells you all the things. That's like a true old style tape. And this one updates every time the price changes. The spread, the size, and last volume traded. And the LTQ. Well, I guess it's not showing you the LTQ. Doesn't show you the last quantity traded, but I don't think that your old style tape did either. But again, so why would the last traded quantity matter? Unless it was a sweep. You're starting college in the summer, G59? That's kind of a interesting way to start. But better now than later. Best time to start is now, rather. Do we make that? I'm closing this now. I'm not opening it back up again. So I kind of feel like coming over to ES and just shorten the heck out of it. Yeah, okay. If you're just trying to catch the spread, I still fail to see how the LTQ is means anything. It's a random number. Unless there was a sweep, and if there was a sweep, like it already happened, right? Like that's the thing. It's a random number. Do you dispute that it's anything more than a random number? Like I don't understand. Like this continually perplexes me. Why do people get in? Yeah, because you don't. Okay, yeah, but that doesn't answer the question. Okay, stop saying that. It doesn't progress the conversation. Okay, right? It's a random number. So I don't understand, why do people get interested in one thing and not another thing? So what is it about LTQ that's so interesting to you that you think that there's a substantial edge in it? But then when I talk about things that are well proven and used by block traders in the industry and has years and decades of quantitative research that has been peer reviewed and published in journals, et cetera, et cetera, et cetera, and you're kind of like, well, I don't know if that really helps, right? Why? But you're interested in LTQ. And what empirical evidence do you have that LTQ is anything more than a random number? Other, why is that? I want to know, why do you find that interesting and not that interesting? Because it doesn't make any sense. This has empirical evidence. I don't know. Maybe it has empirical evidence and you're not sharing it with us, but whatever. What's your thought? I don't really know a whole lot about SMB Capital. Never worked with them. Never been all that interested in. Yeah, you have to do a push up because I said empirical. See, here they're coming down now. I'm like, I want to get in again. I want to get in. My original trade would be a little bit in the money now. Oh no, not quite. I was 357. One's man's trash is another man's treasure. But like, it's a really pivotal question for us in trading, though. FTH, why are we attracted to the thing that we are? Right? Is it because it's actually going to make us money, or is it because we have a reason to think that it's going to work? Right? I can see a single large order in how it ticks through here on the current trades column, and I can see it on the DOM. And yes, unless it's like a 1,000 lot, it really doesn't matter a whole lot at all. Shiny object syndrome. Well, that's definitely something that happens. Like the thing is that here in the treasury, okay, if I come through, so like at 30 half, for instance, well, no, let's wait for one to happen. Okay, we'll see it tick up, right? It's already happened. It's done and in the past. Does it? And so if we tick up, we're at 13 half. We tick up because of a large lot. Let's just say that somebody bought all 500. Does that mean that we should buy at 14? It's not. It's not reliable. It's not reliable. No, I'm not. So I'm moving. I think that you said something. Are you failing to understand the edge in knowing when a single large order hits the market? Prove to me that a single large order hitting the market, and we're talking about something that's on the order, that's less than 1,000 contracts. Okay, something that's less than 1,000 contracts hits the market. Show me that it's indicative of where the action will go in the future. Right? We can test that. I can come through and I could come and write an algorithm that says, okay, when I get an order over this size, I want to buy for a tick or whatever the deal is, and we could backtest that, right? Do you want to backtest that? Might be a little hard to get an accurate result because it's such a short time frame, unfortunately. But so the question is that as low as it goes, or do they push all the way through? Because at the moment they kind of are hinting to me a higher low. I don't know which way it's going to turn out. Do feel a little frustrated about it. Seems like you get these big moves, and then after the big move, it's just noise. Is it possible to backtest DOM work, or is that forward only? So it is possible, but not with the tools that come with the platforms. It is. It is. No, but that it is exactly the point, Lucas. If I went in and I put in the time to understand every little thing that a person on the internet claims is an edge, I would never go anywhere, right? I would sit all day at the computer backtesting things, and probably still wouldn't have found an edge of that nature. Like seriously. You need something more than just somebody saying that it's of value. Like that's the like I got like 2 or 3 things I'm trying to focus you people on. And this is the one that I just don't understand why as much as I focus on it and the number of different ways that I approach it, and I will still have conversations with people, not just Lucas, there's many different people, and they still don't believe it, right? You need more than just somebody on the internet saying something to justify putting investigation into a strategy. There's too many people saying things, and like 99.99% of them mean nothing. They think that there's an edge in it because they were taught it by somebody in a course or something, or maybe they thought that they saw a pattern. And when you actually go in and investigate it empirically, it turns out it's not actually an edge. Okay? So in that world, what should you do? Unless they're providing empirical evidence, ignore them. Sure. Can you show me? You could show me the actual trading. If we had, I mean, how far back of trading would you? I'm a little surprised for you to say that because we've had conversations with you recently where it sounds like you were still kind of frustrated, right? How is it in NinjaTrader 8 level 2 data and time and cells instead of done by What do you mean by that, 007? Sounds like there was some keywords in that sentence missing. Like they're gonna go. A little frustrated that when they went the first time to the lows that I wasn't getting that kind of excursion. I only got... Oh, I guess I got 9. but now they're doing like 12. But there's the other side of that is that when you come to the point of, well, I can show you my actual trading to try and prove that to you. And of course, we would have to have a pretty big record to say that that's like really like compelling evidence. It's not empirical, right? That is basically an admission that I don't have any empirical evidence to suggest that this actually works. Well, the reason that we got, more favorable excursion on that move down was because there was some very aggressive sell volume in the 30-year. So, how would you compare level 2 data and times and sells? I mean, there's nothing really to compare, especially if you're using the bridge. You put them up next to each other and you see that the updates are never more than a few milliseconds apart. I mean, I'm getting a lot of backwash here too, although that backwash doesn't seem to be pushing price up very much. So that's curious. That's kind of like reloading. That suggests to me maybe lower. Let's see if they dig it out. Like, I think that kind of suggests to me lower, but I don't want to pick him off, man. Oh, you know what? That trade that I took in the 10-year that I was frustrated about wasn't actually a live trade. I forgot to switch it. Hey, thanks for stopping by, G59. I appreciate it. No, but that's not. How do you know? I told you there's edge in knowing single large orders hitting the market. You ridicule my saying, well, if only you look at that, then that means nothing. No. Like, well, I did say that, but listen to what I'm saying right now. Prove empirically that that matters. Right? Because here's what's going through in our head when we say that. A large an order is bigger, therefore it must matter more. That's only the logic, right? Now that's logic, that's pretty simple logic, but that's not empiricism, right? Empiricism would be, okay, we have a theory that when a single large order hits the market, it matters. Ergo, let's come in and do a study. And every time that we see a single large order hit the market in the 10-year treasury, we will then monitor how far it tends to go in the next minute after that, or whatever the time frame that we want to investigate is. Right? And then we could come in and if we found a statistical aberration through that, then we could say there is some empirical evidence to suggest that that single large orders matters. By the way, if I was doing that study, it wouldn't be the LTQ, right? Because if there was a big order in the middle of it, you might not have seen that through the LTQ. Because it might have changed too fast, right? Okay, so it did end up pushing lower, like that. What I was saying there did end up mattering, right? Hmm. Do you think big institutions mainly hide big orders? Yes and no, Tobias. So, what I was doing was in stocks, but generally speaking, when you would submit an order, say you're coming in and you're looking at the DOM and you wanted to buy 500 of it or whatever the deal is, right? Then, and I submit the order. When it goes into the systems, most of the time it would get split up. Yes, most of the time. But what you would probably still often see is like one little order at the end that's slightly larger. You know, like if I'm going to buy 500, it's going to split it up into like 50s, maybe. It kind of depends on a lot of different things. I don't understand. Those things were kind of black boxes to me, but generally it would split it up, right? But there are algos out there that would, you know, and features in the software that would say buy everything on the offer, right? Just sharing what I know has edge, but you don't know it has edge. That's the point, Lucas. I think you're focused. So here's the first thing. Please try not to take it personally, because it has nothing to do with you, right? What it has to do with is us, right? From our from our perspective, you have not shown anything to us, right? There's no way for us to logically differentiate what you've said from noise. The only way that we can objectively separate what you're saying from noise is to have empirical evidence backing it, right? If you don't have empirical evidence, then that means that you don't actually know that it has edge, right? Because the edge that you're deriving, if you are making, first of all, we don't know if you're really making money. If you are making money, we don't know on how time frame of it is, like if it's going to continue to make you money into the future, or you know what the track record of it is. Okay, we don't know if the results were from some other thing that you're doing. Did I already say that? I'm probably like repeating myself now, right? It's not, without empirical evidence, we can't really use it, right? Instead, what we have is a theory that we would have to go and do the work on, right? And how do you determine? Because I could tell you what, if you go and you search, you could probably find 100 theories a day to test, right? So how do you decide which theories to test and which ones not? Well, I tell you which ones I test. I test the ones that are already based on it, there was a empirical evidence that we had, and then based on that, somebody has a new theory about how we can take that further. Those are the places where I will investigate a theory, right? Wow, I hate it when my position window does this. There's this issue in Jigsaw where it's like there's an issue with memory, and it'll like your position window will go blank. Why DOM instead of level 2 data and time and cells? Well, it's the same thing, 007, right? It's the exact same data. You're just talking about different ways of presenting the data. And the DOM is the most complete way of displaying that data. Why so? Well, okay, so for instance, when I'm on the DOM here, first of all, I'm seeing the current number of orders in the queue at every price level, right? And on the Jigsaw DOM, I'm seeing how many orders it took to clear the price. And I'm also I'm able to see the orders as they come through. Now, I have these tapes up over here that help me see that a little bit better, but I've not ever found too much of an edge in that. But either way, like, all of the data is there, right? If I go and I have a chart only just shows me how price changed, right? If I do a level 2 thing, it's only showing me the fills on the limit orders. You know, there's not really, to be honest, like, just with the market depth thing, there's not really a better way to show market depth. You can show it on a chart, I guess, but really what you're doing is you're just overlaying a DOM on top of your chart, right? Yeah, there you go. Once you see LTQ, it happened already, like time and cells. Yeah. Like the thing is, part of the reason why I'm having a little bit of skepticism here is that when I see a large order go through like that, really what it means to me is I hope that I was already in the trade and that I'm ready to get out, because we might not be going anywhere for a bit, right? What you said seems a bit vague to understand. Well, Maker, so what he's really saying is find a highly correlated instrument and trade against that highly correlated instrument, right? So it's a little hard to do here in the treasuries because we got the spread. But if the 5-year is ticking down, there's a pretty good chance that the 10-year and the 30-year is going to get dragged down too. See, so it ticks down a tick. So as the 5-year goes down, I'm going to say, okay, 5-year went down, so I want to sell the 10-year, right? Because my value at the moment is really like 07.5. So if I can take a fill on the offer at 08, I'll take it. And then I'll take it off at 07.5 is essentially what he's talking about. You'd have to do it. It's pretty hard to make money doing that in the treasury, though. You would really want a much less efficient instrument, like maybe NQ. Well, that time the treasuries made some pretty good progress on the downside. S&P 500 seems upset about it. I wonder how far we go. Oh, I need to roll over my 6J here. Hold on. I think I would rather try and hold it, but they're kind of making it hard. They're kind of making it seem like it's going to come back in my face again. Why the market now sees an 87% chance of the Federal Reserve hiking 75 basis points. From Forex Live. So like, let me try and approach it from this direction. Here's what I would want to hear for me to be interested. Okay, well, I really like to use LTQ. and be like, okay, well, why? Well, there's a study that shows when, you know, that uses information derived from the LTQ study that I did myself that suggests that it has an edge. And I'd be like, well, can you share that with me? And you'd say, well, no, I can't share that with you. Okay, well, then that'd be fine. But just the fact that you have a study, like you have some data that suggests that it works, would be like, oh, wait, because that's different, right? That's nope. That's not what people usually say, right? People will say, well, I learned from this guy, or I figured this out from watching it, or, you know? Okay, now Michael Saylor is saying that they don't get stopped out unless it goes below 3,562. What advice would you give on how to best to learn the DOM? Well, so number one, I have a series on order flow. I have a 4-part video series, so that's like 2 hours worth of stuff to watch, right? And at the end of that series, I talk about empirical behaviors of markets, the things that we can actually prove. Whereas everything else that I'm talking about is really more kind of like, this is what you'll see and this is what happens, but it doesn't necessarily prove to you like what's going to happen in the future, right? That's just helping you understand what you're seeing, right? So that's where I would start. And then the next thing is you just got to watch it. There is definitely something to that, like you kind of get a feel for the instrument. When you try and switch between instruments, like I switch between the 10-year and the ES, you don't do very well. Kind of messes your rhythm up for some reason. So putting the screen time in is the next big thing, essentially. So you got to understand. So like the thing that is proven about the order book is that when there is an extreme imbalance between the bid and the offer, there's it's highly likely to move, right? But that's something that is too fast for us humans, right? The rest of it is kind of more of a soft qualitative thing, right? I will have other information that I know is very indicative of where we're likely to go. Today, I'm relying mostly on sentiment. I know what the sentiment is and that we're expecting the Federal Reserve will raise 75 basis points tomorrow, and that the longer term trajectory in the treasuries should be that we move to 3.5%, right? And that's why I'm only looking to go long yield short treasury, and I'm just kind of, I have my method of timing it and everything else, right? And then the rest of it is just kind of like feeling it out, right? But I'm not relying on that as like my moneymaker, right? That's just those extra tiny little things that just help you execute it better. Why the DOM and not order flow? Well, they're really the same thing, right? Or order flow can mean different things, but you know, really what we're talking about is an analysis of the orders, right? Now, in order to understand what is happening in the market, we do need to be able to analyze orders, right? Because the orders are what moves it in the end. Okay. But can I see a single order and find an edge from that single order? I highly doubt it. I highly doubt it. I would really have to see some substantial empirical evidence to prove that one to me. So we're getting a little bit of a bid here, but the ES does not look happy. I love how idiot Michael Saylor is. Why would you disclose your point of pain in liquidation? I know, right? Well, like, here's the thing that I think is kind of funny about it is that so they said, like, here's my point of pain. And so then everybody's like, oh no, the market's going to go for it. So then he changed it. So the first of all, the fact that he feels the need to come in and say, oh, actually, we added liquidity and our collateral and our pain point is much, much lower, says to me that he's really genuinely scared, right? So that's the first thing. But the second thing is that the breaking point for them is probably before they get the margin call, right? Like there's a point at which the stock price goes so low that the third thing is he said like 3,000. I know that for the Bitcoin diehards that number sounds like there's no way that it will ever get down to that price, but from what I'm seeing at the current time in the cryptocurrency market, it's a lot more likely than you might think. Man, I tell you what, whoever it was that was trading basically betting on a 0.75 basis point hike starting the beginning of the week I hope they made a lot of money. Because that was I don't think I've ever seen a play in the treasury market shift that quick. Was a 3.9% probability at the beginning of the week, and now it is a 90% probability that the Federal Reserve will hike 75 basis points. I think at 3,400, maybe the Fed will slowly start to step in. If the market gets to 3,400 and it's showing signs of that inflation is subsiding, then sure. That's the problem, is that if we go down to 3,400 and then CPI readings are still high and we're still seeing pressure in the energy market and it looks like that inflation is still getting worse, they're not going to back off. But I personally kind of feel what you're saying. Like, seems to me that at that point they've done their job right. I've heard some say that 100 basis point might be on the table. Is that what you meant to say of live action? Well, given that the 75 basis point is likely, we have to at least put the 1 basis point hike like out there as a possibility, huh? If there was aliens, what do you think they would think of our markets? I don't know. It's an interesting question. Because the thing is we know that markets are not perfectly efficient, right? We know that markets aren't perfectly efficient. Are there better systems? I'm not so sure. I think that like the system of capitalism itself, individuals working in their own best interest. I bet you that if there were aliens that were anything like us, that they would probably be using the same system. But they might not be using a limit order book. Maybe there's a better way of facilitating transactions that's better than a limit order book, right? That's what interests me. Or is it not the problem that isn't the limit order book, but are there other systems and models that we need that are able to make this a lot more efficient? I think Powell did a good job altogether. For sure, he's behind the curve, but compared to other central banks, he did so much better. Well, that's an interesting comment because I personally don't feel like that there's been that much of a dichotomy between what the Federal Reserve is doing and what other central banks are doing. I think the only reason that it seems like it's so different between the US and the ECB is because the ECB didn't experience as much inflation because they didn't put as much stimulus into their economy, right? But example, oil, it apparently doesn't take much to move crude in futures, and amazing how it affects. Yeah, it is. Like, it really is insane. You just got to understand. Like, my two major points that I've been trying to teach here is what markets are not informationally efficient. They're very statistically efficient, but not informationally efficient. And two, that unless you have empirical evidence, it's not worth bothering wasting your time on it. I need to come up with a better way of saying point number two, because again, doesn't seem like anybody believes me. It seems like everybody wants to find the guy that sounds like he knows what he's talking about and copy what he's doing instead of finding empirical evidence. Maybe part of that problem is that empirical evidence is kind of hard to come by in the retail trading world, but it does exist. Well, once they finally broke down lower, now this thing is really starting to run, isn't it? Doesn't Powell know attack the sell side and this pushes oil down and life at the pump gets cheaper? I don't get it. Well, but it's more complicated than that, right? Because if I come in and I sell oil, right? That will push the price of oil down. But if somebody comes in behind me and then buys oil with an equally large meta order, the price will actually end up higher than it was before. So trying to manipulate the market in that kind of fashion would probably work against you, right? Especially if you're not actually changing the fundamentals, right? Like the real issue here in the long run is that we know that the future orders in oil are going to be buy unless there's an economic collapse. So, right? You kind of have to change that dynamic to even, So it's not even worth trying to manipulate the market, right? That's why I say, like when it comes to market manipulation, like things that large institutions can do that are kind of a little, that kind of screw you over. It's not that they come in and they buy a ton of it and mess you up. Although what they can do is they could try and buy a ton and then sell even more to increase the impact of their sell and send it down more. That's a very high risk strategy though. Okay. But the thing that they really can do though is they can adjust their bids and offers. They can say, make it easier for them to push up because I want my fills on my up. So I'm not going to put as many orders, or if anything hits, I'm going to pull all of my orders here in the hopes that it will tick up and I can sell more. Right? That's what they do. Is it has to do with the pulse. That's why I always say, like, there's a lot more informational content in how things pull than you might think. And that, my friends, I think was my exit. No, don't like that at all. Okay, so there's another iceberg. There was an iceberg at 04. They've traded back down to it again. Another iceberg there, 1355. That time they didn't clear it, right? Gonna say not optimal there. Not the optimal outcome. Okay, that time they cleared it easily. Man, look at the 5-year go. 30, you're kind of hanging back on us, though. So I didn't particularly like how I got filled on my exit there because it was being really, really stingy. And then when they did finally take me out, it kind of ran a little bit. So now I'm kind of sitting here going, it looks like they're gonna flip through me here, right? Like it may have been the better choice to have stayed in that. That's not true. The order book always moves in the direction to where most orders are located because the task of an order book is to execute as many orders as possible. No. So number one, the existing orders that you can see on the DOM is not a reliable indicator of where it will go. You will find situations and moves where it is, and you will find situations and moves where it is not. The idea that the market will move to where the most orders are executed is how do I put this? It's wrong. What's really happening is a liquidity hole will be formed and it will trap price in that location. And because price stays in that location for so long, it ends up being where the majority of the orders end up taking place. But it did not go there because that's where the orders were going to happen. In fact, it goes there and that ends up happening because the market makers didn't want to trade it. So it's actually the opposite of what people suspect. Or at least that's my interpretation of the empirical evidence that we have on that issue. That's how Bookmap works, right? Don't know what you mean. The thing that I'm talking about like a liquidity hole forming is you can't really see it on those Vista charts, I don't think. What did I get out at? 8.2. Oh, wait, what? Really? No, that's not right. 3.85. Wow. Okay, yeah, I did miss about $15 there. So what I'm seeing right now is that where I got out at and where was it? I think it was like at 04. Yeah, I think it was at 04. There was a little bit of a liquidity hole that appeared to be forming, and then they shoved through it and they slipped further. And now I'm seeing a potential liquidity hole forming at 115 even. Right? How do I see that? Because, well, at the moment, there is more volume that's traded there, but 5,000, relatively speaking, isn't a huge deal, right? But what I'm seeing is I'm seeing these icebergs form and stuff. And it might not even be an iceberg that shows up on the thing, but like what I'm looking for is a large amount of volume trades very quickly, and then the liquidity is flighty in that location. And the liquidity being flighty in that location, not holding very, very well, is not something that you see on a Vista chart very well at all. So it's a little bit hard to read in this current market volatility because it will tick up and down like very easily. But I think you'll notice that if they tick down 0.00 right, that this 115 even will pull very easily. It'll pull very easily, and then when it trades, actually a lot will trade. So that's kind of what I'm looking for. But what you will often see in a trend is you'll get a spot like that, and then they'll make another push, and they'll come back to that spot, which is what looks like they might do here, is they may come back to the 04 area. So for me to have taken $20 off of it isn't bad, but I could have done a little bit better. I could have taken the risk, and I think in this situation, it would have behooved me to have taken the risk on a little bit more and waited for it to try and do that push lower, and then maybe gotten out at 3.4. You can see that somebody else did that in the micros, right? So could do better, but if I come through this and I catch something that's better than sitting on the sideline like it did yesterday. Mohammed El Rain on CNN today saying the U.S. will hit 9% inflation in the next few months. Wow, that wouldn't be very good. If big institutions don't want to execute it, then they can still place orders and it will temporarily try to move this direction because there are most orders. That's what I mean with manipulation. Yeah, it doesn't work that way. What I think you're, let me see if I get this right, Tobias. What you're saying is, if we're sitting here and I see a 1,500 lot order at 114.29 sitting out there, then the market will move to that location because they want the liquidity or whatever the deal is, right? And that order, by me placing that 500 lot there to make it appear to be 1,500 at 29, it makes it more likely to go there. That's what I think you're saying. And let me put it as a theory. It sounds like a theory. Okay. But I have a considerable amount of evidence that suggests that theory is wrong. Okay. And the first piece of evidence that I would show you is that you can take my indicator suite, and I have a bunch of level 2 indicator sort of thing, and it will show you like cumulative market depth histograms that do filtering to filter out the orders that are like stacking and pulling constantly, right? To kind of identify which side has more orders that are being stable there, and ergo will it go to that location. And when I was watching that really closely for a while, trying to think about a way to make an algorithm that used that, that was the first thing that I looked at, because people have always said that. People in the order flow world always say that. And what I found was that it was inconsistent. I would go through a market regime where it would always go towards those prices. And then I went through a market regime where it always ran away from those prices. And like if a big order like that showed up, especially if it was like on the inside, it ran away from it. So it's not reliable, was the first thing. The second thing is that what we find is that the place that it tends to hang out at is areas of low latent liquidity. So when I say latent liquidity, what I mean is that how much is being shown on the bid and offer doesn't tell you very much. Well, it's not that it doesn't tell you very much, but it'll trade. They'll go through and they'll trade that. So that's not a true indication of how much liquidity there really is in that location, right? But as it's cleared and it trades that over and over again, then you get an idea of what the latent liquidity is. And you will come into these areas where the market makers just don't want to hold many orders out at that location, right? And it often happens because too much volume already occurred there too quickly. And so all of the market makers that were willing to trade in that location are already filled and unable to take on more inventory. Okay. So this is what we call a liquidity hole. And there's some math and empirical market observations behind all of this to show that like these form. And the basic gist of it is that when you get a liquidity hole, it constrains price. Like they did come back to 04. This is a pattern that you'll see in the markets, right? The number of times that you'll see this pattern occur in the markets is pretty crazy. I wouldn't trade just on that sort of a thing, but if there's anything that I regularly see that I think that you could try and base your technical analysis strategy purely on that thing. It's probably that liquidity hole. Like in a trend, if we're getting a strong trend, liquidity hole, push further, return back to it. Now, sometimes it will just stop right there. Like I was afraid that it would just stop right there. But if they push through it, it's usually good for a reversal. To say. I'm more technically speaking, I mean, the concept of an order book is to execute as many orders as possible, for sure, because liquidity holes in market orders, it's not consistent. I agree. Well, I'm not even sure if I can agree that the purpose of the order book is to execute as many orders as possible. I mean, the purpose of the order book is to facilitate trade. I don't know if there's anything about the order book itself that necessarily induces people to trade more. Possible, but no. But what I was hearing was seeing an unusual order means that we're likely to go to it. It's not true. I shouldn't say it's not true, because I feel like that when I say that, I'm like putting like the final conclusive, this is the way that it is, and we can always do more research and maybe we can discover more about that. But our current understanding of the evidence, our current understanding based on the evidence suggests that that's not how it works. Wait, what? Lewis Curran. How the Fed and Biden got inflation wrong, by the Wall Street Journal. And this guy says 2 observations. Biden's stimulus with Fed support was a determined social engineering plan by Democrats to buy the next election and ensure Trump never came back. 2, China warned this would happen. Let's see here. China will not resort to quantitative easing and will maintain normal monetary policy as long as possible, since economic growth is still within a reasonable range and inflation is mild overall. The unprecedented monetary easing adopted by major economies after the 2008 financial crisis has made it very difficult for them to exit the zero rate condition. They are forced to make unconventional policies, monetary policies, a new normal, he warned. It's true. You know, like you go over to Japan and you look at what's going on in Japan right now, and it's pretty hard to not realize that there are long-term negative consequences to zero interest rate policies, and they're very negative for your country's growth in the long run, and they're very difficult to break out of. I think that such policies should be extraordinary measures only enacted during times of dire emergency, and that we should be willing to take on a little bit of pain to exit those conditions as quickly as possible, because the long-term consequences to society are worse. I see that. But what is it that he's reading in this article? I won't be able to read it. I'll have to subscribe, right? Oh, no, wait. It's going to let me read it. I'm not going to read the whole thing to you. Let me see if I can find the spot where maybe they say that. So there's no political bias in that article? Well, I don't. So far, what I'm reading here in this article, it does sound like an opinion article, okay? I put it wrong, maybe. The purpose of an order book is to match buyers and sellers. I don't know if that implies the order book tends to go where it can match the most of there. Okay, there you go. Yeah, exactly. Now we're on better ground, I think. A little disappointed that on that last trade that all I was able to get out of it was 20 bucks in a market that seems like it's going a lot further than that. But I kind of finagled around a little bit. Could have gotten a substantially better price to begin with. Probably could have made almost 50 bucks on that move if I had played it well. Like if I had made the original trade and kept it, and it was that the original trade was not a live one, the second one was a live one. But if I had made it as a live one and it had followed through, probably could have made 50 bucks. And then I would have probably just taken the 50 instead of my looking for the liquidity hole for the exit. But let's see here. So here's an interesting part in the article. Miss Yellen believed Summers might have a valid point with his analysis, according to people familiar with her thinking at the time. But based on her experience of the last expansion, she believed and repeatedly advised Mr. Biden that doing too little was a greater risk than doing too much. These people said the best thing we can do is act big, she told lawmakers. Her view on inflation carried particular weight. Okay, so the whole inflation is transitory thing is something that we can pin on Yellen. So this is just kind of this whole thing about how why did they actually get their projections wrong, essentially, and like what was their thinking. This is written by Timmeros, it sounds like. Yeah, it was written by Nick Timmeros and John Hillenstrath. So he is familiar with their thinking. So this is going to be, I'm going to come back and read this again later to try and get a better idea of what is I don't know if the link will work for you guys if I post it in here, but I think that this could give us good insight into how things were working behind the scenes. But this guy's claim that the stimulus was social engineering to buy the next election and ensure Trump never came back, I don't see that supported by the article. There is a little bit of a combination of opinion and fact in this. But their main takeaway here is that they're saying that they fought the last crisis. Now, it seems to me like they're still kind of missing the big problem. Like the thing is stimulus isn't bad in and of itself. Everybody gets caught on this argument. Should we do stimulus? There should either be stimulus or there should be no stimulus. Okay? Like, that's what people think the argument is. No. No. Okay? We answered that one like 60 years ago, guys. That argument is long gone. Okay? Keynesianism, or the idea that you can stimulate the economy with monetary and fiscal stimulus. Yes, you can. There are positives and negatives to it, but it does work. Okay. The problem that we had in this situation wasn't that we did stimulus and stimulus is bad. It's the nature and size of the stimulus is paramount as to how effective it will be. And in this particular situation, number one, we spent way too much. And number two, the way that we spent it was basically in a way that only incentivized consumption and not production, right? And so what we did was we kept consumption levels high to the point that people were buying 10% more stuff from China than they were before the pandemic. And that created a supply issue in of itself. Like, that strained the supply system, and then at that point the supply system becomes very inefficient, and then things become worse. Our total supply becomes less, right? And that's why we saw what we did. But they're still kind of stuck on this, well, we have to do stimulus, right? What I would love to see in this article is, well, it was necessary for us to, come in aggressively and support the market, but we should have done this much instead of this much. We should have done this policy instead of this policy, and we should have removed the stimulus sooner. Okay. So what are some of the changes that we could have made? I'll tell you one. Number one, shouldn't have given them unemployment for so long. Right? The whole thing where you would make more money from being on unemployment than otherwise was a very bad call. Republicans warned them about it. The Democrats went through with it. The states that didn't have the extra unemployment had unemployment was reduced more quickly. You notice that everybody stopped talking about that once it came out on the Republican side. That's the first one that sort of should have changed. The second thing that should have changed was when you're spending all of the money, like with PPP and everything else like that, you should have given an extra incentive to anybody that was doing manufacturing in the United States, or that was part of transportation. It would have reduced inflation substantially, right? But at this point now, it's turned into Biden's oil policies are bad. That's another problem. So all of the anti-oil industry regulations that he implemented on day one should just never have been a thing. Do you have any idea how many? Well, I don't think that anybody does, but we have a decent amount of evidence to suggest that there was a substantial amount of fraud with PPP loans. Yeah. I remember talking about it at the time. Remember, we were reading through the qualifications and everything, and I was like, well, I could pretend that my stream is a bigger business than it really is and qualify for PPP loans and then hire people and do stuff with it. Yeah, I could have. And I would have made a lot of money off of it, but I was not really money that I thought was really the intended purpose. Yeah, that was really quite wasteful the way that they administered PPP. It goes back to that thing that I was saying the other day. Monetary, when you have a purely financial crisis, that is a crisis, the reason that the economy is in shambles is because there was an issue in the financial system, then really your problem at that point in stimulating growth afterwards is just a crisis of confidence. And In that situation, monetary stimulus is very effective. But in the situation that we're in, where it was caused by a natural disaster, and that natural disaster created severe disruption to supply chains, causing the economic problems, your stimulus is not going to be as effective. Or at least the kind of stimulus that we're talking about is not going to be as effective. You're going to have to target it towards that supply chain. And basically, the way that they targeted the stimulus was they wanted consumers to be able to buy as much as possible, and they gave basically nothing to the supply chain. So I get why this person would come in and say, well, this was all just designed to try and social engineer things so that they would get reelected. But it was really quite a short-sighted decision if that's what they were trying to do, isn't it? Well, it's interesting. We do here, by the way. Okay. I was wondering about, were people more interested in watching once I had taken that position? But I don't know. I've never noticed a consistent answer to that in my numbers. I don't think that I'm clear enough about when I'm in a position for it to matter, which is probably what we want. That's good. I somehow think that maybe they also wanted higher inflation. Well, yeah. No, I think they did. Yeah. I think that this was engineered to try and increase inflation, and as a result, bring up people's wages. Yeah. It's just that, like, again, that would have been a good thing, honestly. Like, to get back to the 2% target and maybe a little bit above that, so that on average it's 2% would be a very good thing, because not having having zero inflation, or not zero inflation, but below target inflation for a decade really was harmful to the middle class and income inequality and all of these other things, right? But I don't think that they ever in their wildest dreams thought that we would be getting, 10% inflation numbers. Really, when you think about it, the people saying this was really bad, if you had asked them, like, how much inflation you think we'll see, and they would have said like 10%, right? So they would have been right about on the money. But anyways, good times. Tomorrow we're going to get the Federal Reserve meeting. That should be crazy. Keep, stay frosty over here if you're going to be trading the Treasury, because it still looks, I think that there's still a possibility of further downside action. We're also getting a very volatile market, so might be difficult to hang on to. But tomorrow we got Federal Reserve meeting, and that's going to be just insane. Wild zoo. So I will see you guys tomorrow. 2 times tomorrow. We'll be there for the announcement and press conference at 2 p.m. Eastern time, but we'll also be there regular stream in the morning. So see you then. In the meantime, stay profitable, friends, or at least don't blow it all.